That's just 1.8% of China's total auto exports. The US simply isn't a core market for Chinese vehicles right now, and we already knew that before the tariffs. Instead, Chinese companies have been building what I call a diversified parallel market system. They've been rapidly establishing global production, which allows them to kind of weave around the tariffs. What's going on, everyone? My name's Obi and welcome back to Courtside Financial, the podcast where we talk about business and technology. Today we're going to be talking about something that we haven't been giving enough coverage lately. We've talked about on the channel and we've talked about leading up to, but we need to discuss it some more, and that is going to be Trump's new tariff policy. We're especially going to focus on how it's affecting the automotive industry. Before we jump in, I want to thank everyone who engaged on yesterday's episode, which was a follow-up to the topic regarding CATL's potential increased investment in NIO's battery swapping business. The conversations and comments have been incredible, so thank you all for keeping me on my toes. Today, though, we're switching gears and talking about a financial thunderbolt that struck the global economy. On April 2nd, the White House dropped a bombshell, a 34% reciprocal tariff on Chinese goods, which comes on top of the 20% tariffs from 2018. And if you do the math, that's a staggering 54% total tariffs on Chinese import. And just a day later, another hammer fell. A 25% tariff that took effect on April 3rd. Well, China didn't waste any time responding. Starting today, April 10th, China is implementing a 34% counter tariff on US imports. This is financial warfare happening in real time, and today we're going to break down what it means for the automotive industry, consumers, and potentially for stocks like NIO that we follow closely. Trump's executive order is quoted, and I'm quoting the full name here: regulatory imports through reciprocal tariffs that correct trade practices that result in persistent large deficits in U.S. merchandise trade. Now that's quite the mouthful, right? The White House claims that this is about resolving America's trade deficit problems, boosting tax revenue, and bringing industry jobs back to the U.S. But here's the kicker. It's not just about China. Major Asian exporters are facing tariffs above 25%, with Vietnam getting hit with a massive 46% tariff. Japan, South Korea, Thailand, Cambodia, they're all at a crosshairs as well. Now, I've been tracking the markets long enough to know that in trade wars, there's rarely any true winners. And this situation is proving that dramatically. China's 34% counter tariff is going to send shockwaves through multiple industries, but the auto sector might feel the pain most acutely. Let's talk about what this means for the automotive landscape. First off, American car brands in China, they're about to face a brutal uphill battle. Ford, General Motors with their Cadillac, Buick, and Chevrolet brand, amongst a plethora of automakers, they were already struggling with sales in China at this point in time. And now it's obvious that they're about to get hammered even harder. I'm looking at the numbers here and they're eye-opening. High-end fuel SUVs and pickup trucks made in America like the Tahoe, the Raptor, the Navigator, these are going to see significant price increases because of this. They're going to see profit increases as a result, and sales decline as well. It's not just American brands that will suffer either. German automakers with US factories are also caught in the crossfire. Mercedes-Benz imported 65,500 vehicles from the United States to China in 2024. The GLE was their top model with 45,900 units, followed by the GLS with 14,900 units. BMW imported 19,400 vehicles last year from the US, including 8,167 X4s and 7,257 X7. All of these models are now facing an additional 34% tariff on top of existing rate. The impact is going to be so severe that automakers are already scrambling to adjust their production strategy. BMW in China has already moved X5 production to their plant in China, and Mercedes-Benz is planning to manufacture the GLE in their Chinese Beijing facility. This kind of rapid industry-wide reshuffling happens when policies become a reality overnight. But look, again, it's not just Chinese consumers who are going to feel the pain. American consumers are also in shock with that 25% tariff increase on imported vehicles. According to S&P Global data, nearly half of the vehicles purchased in the US last year were assembled outside of American borders. I can certainly say that my car is foreign. And even American made vehicles, they typically contain foreign parts. This means that even if Americans stick with their current cars longer, they're still going to pay extra for replacement parts, and they're going to feel that increase when they go to their service centers. Goldman Sachs is predicting that US new car prices could jump by 5 to 15,000 due to these tariffs. That's real money coming out of consumers' pockets. That's you and I. Now, how's this playing out for specific automakers? About 85% of their supply chain is in North America, and key components like batteries and motors primarily come from local suppliers with free trade agreements. But that doesn't mean that they're completely immune. Elon Musk has acknowledged that imported parts like Chinese-made lithium-ion batteries are going to feel the impact of these tariffs, but they're also aware that Tesla's in a better position than most. The automaker that might be slightly hit the hardest is Hyundai. In 2024, Hyundai sold 1.77 million units in the US, with millions of those exported from South Korea. That's 56% of their sales coming directly from Korean factories. The tariffs could add approximately $7,500 to the cost of each vehicle, a massive hit to their competitiveness. Hyundai's trying quickly to adapt. They've announced a massive $21 billion investment plan in US manufacturing, basically wanting to create an EV plant capable of producing 500,000 vehicles. But here's the thing, they can't react quick enough. The new capacity won't be ready for years. In the short term, they're caught in a very difficult position if something doesn't change. Now let's bring it back to the Chinese EV makers we follow closely on this program. There's actually some interesting data out there. China exported 6.4 million vehicles in 2024, but only 116,000 of those went to the US. That's just 1.8% of China's total auto exports. The US simply isn't a core market for Chinese vehicles right now, and we already knew that before the tariffs. Instead, Chinese companies have been building what I call a diversified parallel market system. They've been rapidly establishing global production, which allows them to kind of weave around the tariffs. BYD built its largest factory overseas in Thailand with plans to manufacture 150,000 vehicles annually. They're also making steady progress on their Hungarian base to serve European customers as well. Chery Automobile established a partnership with Spain's Ebro to serve Southern Europe, and they're planning a Vietnam factory which should start production in 2026. Their goal is 80% localization to keep costs competitive. Geely Auto has 6 major production bases across Eastern Europe and the Middle East. They're planning for 50% of their overseas sales to come from local production by 2030. CATL, who we discussed yesterday, has strategically built battery factories in Germany and Hungary to support local production and keep costs competitive. What's particularly interesting is that despite the tariffs, China's auto exports continue to grow. The projection for 2025 is 6.7 million vehicles, up 5.8% from 5.86 million in 2024. Yes, that growth rate is slower than what we've seen in the past 3 years, but it reflects a shift towards higher quality exports rather than volume. This brings me to a point that I've been emphasizing on this channel almost daily, is that the global automotive industry is going through a significant restructuring. These tariffs aren't creating new trends, but rather they're accelerating already existing. If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. Companies are regionalizing production, shortening supply chains, and focusing on particular markets where they have competitive advantages. So where does this leave us? Trump's reciprocal tariff has triggered a strong response from China, with the US imposing a 34% tariff on Chinese goods and China's response going into play today. We're seeing company profits shrink, and consumer costs rise on both sides. This is the definition of a lose-lose situation. The increase in tariffs will drive up living costs for American consumers while simultaneously hurting American companies' sales abroad. Meanwhile, the Chinese industry appears to be responding with diversification, accelerating the localization of high-end models while exploring different countries and continents as well. Anyways, as I say oftentimes on this show, I aim to be objective, and you guys know I have my preferences though. These overall tariffs don't change my bullish stance on companies like NIO. They do emphasize the importance of watching how companies respond to geopolitical headwinds. Anyways, that's going to be it for this episode of the Courtside Financial Podcast. If you found this episode insightful, useful, informative, at the very least entertaining, make sure to give me a subscribe, and I'll catch you guys in the next installment. Thanks for tuning in and coming along for the ride. Peace out.